Welcome to Nasdaq Trade Talks, where we meet with the top thought leaders and strategists in emerging technologies, digital assets, a regulatory landscape, and capital markets. I'm your host, Jill Malandrino, and joining me this afternoon, we have Kevin Davitt, head of index options content at Nasdaq, and Joe Mazzola, head trading derivatives strategist at Charles Schwab. We're here to discuss index options volatility and retail investor positioning as the market looks ahead to the election. It is great to see the both of you. Welcome back to Trade Talks. And Joe, let's kick it off with you. What are some of the factors that are influencing what you're seeing within the volatility space?
Yeah, well, I mean, leading up to today, and even today for general, just because we are still kind of elevated in terms of volatility, you saw a lot of kind of hedgers step in the last couple of weeks around event risk, of course, around the election, but then other things as well too. I think some of the geopolitical risk has subsided a bit. You've seen some of that kind of taken out today in the VIX, but ultimately, when you look, relative to where we are from maybe where we were a month or two ago, you're still seeing a lot of people that are buying some of that downside protection. And they're not necessarily being rewarded for that. I think that's important because not only do we look at implied volatility, which remains elevated, but the difference between the implied versus realized, basically meaning how much did they pay, whether or not they're getting any bang for their buck. They're just not. They're paying a lot for the volatility, but you're not seeing the requisite movement in the underlying S&P 500 to justify those costs at this point.
Yeah, and Joe, this seems to somewhat be the trend, at least recently anyway.
Yeah. No, I mean, I'm sorry. I think that's important just because this is something that could carry forward into the election and carry forward afterwards. I think the biggest question is whether or not, we know there will be an outcome, but just how long will it take before we get that outcome? And I think that's what people are starting to maybe push those hedges out a little bit further a couple of weeks than maybe what we saw before is, there is some question around how long will it take to kind of get that final outcome.
Yeah. Kevin, equity indexes, of course, they're at or just off all-time highs as the market looks ahead to the election in less than 3 weeks now. How is that playing out in the index option volatility markets?
The points that Joe referenced already have absolutely been playing out. Jill, as you know, I kind of tend to see the world through the lens of the Nasdaq 100, which, like you mentioned, is roughly 2% off all-time highs as we speak. What I observe through that lens is that we see a steeper skew, and Joe mentioned that as well. And I think there are countless ways that you could potentially track skew. One of the most frequently referenced compares the implied volatility, which is, again, what Joe was talking about. You're paying for implied volatility and then comparing that to what's subsequently realized. So the implied volatility of 25 delta puts, the out-of-the-money put, versus a 25 delta call with the same 1 month expiry. And that's what we're seeing in this risk reversal chart, if you can pull that up from Spot Gamma. So in short, the wider the spread, the richer the out-of-the-money puts are in volatility terms relative to those calls. And what I think is particularly interesting or potentially unusual about this time is that the markets have not been selling off. So we're looking back at a 1-year time frame. And what I would call attention to is the fact that the other times the risk reversals were this wide, the index, the Nasdaq 100 itself, was at or very near a local bottom. And we are simply not seeing that. But like Joe referenced, your geopolitical issues, your election uncertainty and known unknown are playing off in the supply-demand dynamic. There continues to be fairly meaningful supply for downside protection, which the market has not been realizing significant vol lately. The forward vol measures are coming in today, but overall the spread between implied or forward-looking vol and what's been realized, there's been a significant spread there.
Yeah. And Joe, what's interesting too is we will be in the thick of earnings as we're going through this election cycle as well. What type of strategies might make sense given that backdrop? Is there anything that you're seeing from Schwab clients in terms of how they're positioning?
Yeah. I could talk about the equity skew for a little bit here. So what kind of was really prevalent over the last year and a half was this idea of buying the upside calls, specifically on some of the tech names, Magnificent Seven, being the real leaders there. So basically what clients were doing, or I think, traders in general, they were looking for a lot of those upside opportunities, buying those calls, expecting big moves to the upside in some of those Mag 7 names. Rewind to what happened back in July, where you didn't get those moves. You didn't get those moves to the upside. And that really started to kind of flip. It really started to flip how investors and how traders were looking at some of those options. You really started to see that skew move back a little bit more towards normalized, away from some of that upside call buying, moving back into more, protective type strategies, not necessarily to the same extent that we're seeing at the index level, but some of that FOMO, that fear of missing out, that really has dissipated in the last couple of months, at least in my opinion. And we can see that when we look at the call skews on some of those names, whether it's a Meta or whether it's an Nvidia. If we were to look a year ago, kind of where those were trading relative to where they are now heading into earnings, it looks like a dramatically different landscape.
Yeah. And Kevin, taking the election out of the equation, what do you think matters most to the markets over the next few months?
So just briefly in terms of strategy, and then I'll talk about the election aside. I think extrapolating on Joe's point that put spreads could screen attractive in some of these more sensitive names on a vol relative basis because of what we've alluded to already, this skew where those out of the money puts in volatility terms are relatively expensive. You could own that at the money, selling out of the money, and potentially do well on that. One other thing that I think we're seeing is that people that are looking to potentially lighten their direct equity exposure going into the election are looking at this skew dynamic and saying, well, these out of the money calls are relatively cheap and these out of the money puts are relatively expensive. I could kind of replicate long index exposure by owning calls, selling puts, and expressing that through a volatility view. Now, your question about the election, and I think Joe brought this up earlier, is like a question of how long until we have an outcome. But beyond that, I think that rates will continue to sort of be an overriding narrative and a factor into the equation. The first rate cut arguably did very little to bring down yields further out on the curve, but now the futures market is in line with the recent Fed dot plot. And Q3 earnings, which started last week and are now front and center. My colleague Michael Normile, part of the economic research team at Nasdaq, put out a great piece yesterday about expectations and looking at the broad market. Earnings are expected to grow by about 2.9% annualized. That would be the fifth straight quarter with positive earnings growth. Really great backdrop economically. This shows the earnings growth for the Magnificent Seven and then the rest of the S&P 500, which has been that overriding narrative lately over this calendar year. And expectations are higher for the Magnificent Seven, which has been the case for quite some time now. But as Michael points out, the earnings growth picture is broadening. That's really beneficial. So I'm going to have my eyes on the yield curve, earnings numbers, and from a business perspective, the continued growth in volume for NDX index options.
Yeah, it's so interesting, Joe. And I think you and I have covered this before, where the economy, for all intents and purposes, to Michael Normile's point, it's good, right? It's not like the trajectory is weak in any measure, but it's interesting. It feels as if public perception out there is not quite as bullish on the economy, even though you're seeing your 401k account savings and so forth accumulating, right? And it's just, it seems like there's like a disconnect there. And I wonder, I would imagine that a lot of these election headlines play into that. And I think back to your original point, it really is going to matter in terms of transfer of power and how these policies are formulated. I mean, even think about it from the corporate perspective. If you're unclear of what tax policy is going to look like, that's got to make it really challenging to forecast as well.
It does, but I'd also think about this point as well too, and that's that. Remember, it's really a combination of the executive branch and the legislative branch together, right? Because outside of tariffs, there's not much that can be done. Excuse me, it looks like I lost my earpiece here. There's not a ton that can be done exclusively with the executive branch. So, keep that in mind. I will say this, and we get this question quite a bit from clients. It's this idea that, hey, why do markets keep going up, right? Like, what is happening? What's the catalyst that's occurring right now? And my answer is as simple as it might be, is that, look, the economic backdrop is still supportive of stocks. We're starting to see the Fed cut rates, which is putting a little bit of a backstop there for the stock market, which absolutely helps in valuations, right? You see interest rates go down, that helps expand multiples, which gives stocks room to grow. And even as Kevin mentioned, expectations for earnings for this quarter year over year around 3%. That's a pretty low bar. And they've come down quite a bit from the 7% that was expected just a few months ago. So you put a low hurdle down there. We saw the financial stocks or financial companies kind of blow those earnings out of the water and really predict what looks like a healthy economy going forward. Yes, the job market's slowing. That's okay. But what we also realize that inflation is coming in as well, too. We got a good retail sales number earlier in this week, and it's showing that the consumer is still relatively strong. So all in all, it's a decent backdrop for equities to continue to rally.
Yeah. And by the way, if corporates performed well in a higher inflationary and higher interest rate environment, it would suggest that, going forward, that should alleviate some of that as well. Appreciate both of your insights as always. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.